Global financial markets trembled as Australia's central bank surprised investors with an unexpected interest rate hike. The Reserve Bank raised rates by 25 basis points due to accelerating housing inflation, catching analysts off guard. This move triggered a rapid surge in the Australian dollar, which climbed over 1.2% against the US dollar. Consequently, Asian equity indices sold off sharply as regional sentiment turned risk-averse. The move also raised concerns about potential spillover effects into broader emerging market capital flows. In pre-market trading in the US, futures contracts for the S&P 500 and NASDAQ showed modest gains, but volatility was clearly elevated. Investors are bracing ahead of key economic data releases, including updated consumer inflation and employment statistics. Treasury bond yields rose slightly, with the 10-year yield reaching 4.28%, reflecting nervousness about inflation persistence. The US dollar index climbed moderately, exerting pressure on commodities like gold and oil. Traders remain divided on whether the Federal Reserve will shift tone or hold steady as autumn approaches. The cryptocurrency market experienced severe pain as Bitcoin plunged nearly 6.7% intraday, reaching the $56,000 support level. The drop coincided with reports of impending legal action against major crypto traders in South Korea, alleging capital flight violations. Ethereum was not spared, falling to approximately $2,950 under heavy selling dynamics. Solana plunged about 10%, dragging down the broader altcoin ecosystem. The total crypto market capitalization contracted by around $87 billion, exposing vulnerabilities across derivatives and retail circles. Stablecoin dominance surged as investors sought refuge from chaos, with USDT and USDC volumes rising by over 30% on major exchanges. Trader sentiment feedback showed sharp increases in fear and greed index scores, skewed heavily toward extreme fear. Liquid exchange balances spiked as withdrawals accelerated, leading to sporadic outages at some platforms during peak volatility. This movement suggests heightened de-risking behavior among retail participants. Analysts note this as a potential precursor to short-term capitulation rather than opportunistic accumulation.
Tesla stock encountered selling pressure following an announcement by Chinese regulators investigating the safety of its autonomous driving system. A recent fatality involving a Model Y in Shenzhen, allegedly operating under self-driving mode, sparked scrutiny. Tesla shares tumbled by approximately 4.5% before the open, dragging down peer EV names like Rivian and Lucid to varying degrees. Market participants flagged this as renewed geopolitical risk in the global EV supply chain. Additional regulatory headwinds may emerge if the probe deepens. Italian political developments unsettled European markets as Prime Minister Meloni's coalition faced a no-confidence vote. Italian sovereign yields spiked to 4.68%, widening the spread over German bunds significantly. The euro dipped below 1.083 in FX markets on mounting fears of fiscal instability. European banking stocks under heavy pressure, with regional lenders losing over 3% intra-session. The European Central Bank reiterated its commitment to financial stability, but refrained from intervening directly. Corporate bond spreads in Europe widened as risk premiums increased across peripheral issuers. Market volatility in fixed income rose amid slower growth signals and higher yield curves. Investors rotated into high-quality safe assets, reinforcing demand for German government debt. Credit default swaps costs edged up for Italian and Spanish issuers. Analysts view the shift as a potential turning point in investor risk appetite, especially for yield-hungry institutional portfolios. Commodities moved unevenly as Brent crude oil rose above $86 per barrel amid a suspected drone attack on a Russian refinery. The disruption may slice production by approximately 150,000 barrels per day, fueling short-term supply concerns. Gold, typically a safe haven, fell by 0.6% to around $1,932 as traders liquidated positions to meet margin calls. Copper remained stable despite weak German manufacturing data, hinting at constrained supply-side support. Meanwhile, wheat and corn futures declined as investors pulled back broadly.
In the U.S. labor market, ADP reported private payrolls rose by 345,000 in July, well above expectations. Key sectors such as leisure, hospitality, healthcare, and construction led the gains. Wage growth, however, decelerated slightly, raising eyebrows over consumer spending capacity. The unexpected strength briefly buoyed equity sentiment before macro caution returned. Fixed income markets responded with modest tightening in shorter duration credit spreads. BlackRock CEO Larry Fink made waves declaring the traditional 60-40 portfolio model obsolete. He advocated for a shift toward private credit and infrastructure investments amid elevated interest rates and economic uncertainty. Financial markets responded, with BlackRock shares up 1.2% as the investment thesis resonated among institutional buyers. Goldman Sachs echoed the sentiment by reaffirming bullish guidance on private debt for the coming years. The debate over liquidity and yield continues to dominate asset allocation discourse. China imposed new data export restrictions on technology firms, targeting user privacy and overseas service providers. Alibaba, Tencent, and Baidu shares dropped sharply, losing over 3% in Hong Kong trading. China's broader digital economy faced renewed constraints, reinforcing capital flow caution. Investors scaled back risk exposure in Chinese tech, driving the Hang Seng Tech Index down by 2.8%. Analysts anticipate further regulatory tightening will cloud overseas expansion strategies. Defense stocks rallied as escalation between Israel and Hezbollah intensified along border regions. Companies like Northrop Grumman and Lockheed Martin each climbed over 2%, driven by geopolitical risk premiums. The Israeli shekel weakened versus the dollar, while local equities held steady on strong bank earnings. Oil markets remain alert amid potential disruptions to energy corridors. Should conflict widen, commodity price shocks and regional instability may escalate further.
Disney beat Q3 revenue expectations with $24.1 billion reported and strong park attendance. Subscriber growth in Disney Plus exceeded forecasts, but leadership warned of headwinds in advertising due to macro softness. The results lifted media stock sentiment, with Netflix and Paramount trading higher. Despite upbeat fundamentals, the broader entertainment sector continues to face pressure from economic cooling. The stock reaction highlights the current environment's mixed signals. Moderna announced emergency approval for a combined COVID flu booster in Japan, boosting its stock by over 9% in pre-market trading. Pfizer and BioNTech also posted minor gains in tandem. Analysts suggest the combined vaccine rollout could energize fall season vaccine sales amid renewed flu concerns. Regulatory clearance varies globally, but momentum remains positive for biotech innovation. Market watchers expect increased demand if approvals follow in the US and EU. UK Chancellor unveiled an $18 billion fiscal stimulus package focused on green initiatives, small business support, and tax relief. The policy announcement pushed the FTSE 100 upward by 0.7% as investor sentiment brightened. Gilt yield curves steepened slightly, reflecting higher issuance expectations. The British pound gained modestly versus the euro and dollar. Economists remain divided on whether the stimulus will deliver sustainable growth momentum. Nvidia surprised markets with a $3.2 billion acquisition of a UK AI language startup, accelerating its AI infrastructure strategy. Shares rose around 2% following the deal announcement. The move reinforces Nvidia's position in enterprise-grade AI platform development. Industry analysts celebrated the step as timely amid expanding demand for neural processing units. Nvidia remains the dominant AI hardware provider by revenue and market share.
Pension funds and institutional investors are reallocating capital into commodities and private equity, pivoting away from public equities. Term sheets and deal activity have slowed noticeably as uncertainty dulls investor appetite in traditional markets. Public market valuations continue to compress as risk premia rise. The pivot to yield-bearing strategies reflects a fundamental shift in portfolio construction norms. Industry leaders warn of underfunded retirement systems if capital remains misallocated. Public-private real estate valuations are under stress in major U.S. cities, such as San Francisco and Chicago.
Loan defaults increased in CRE portfolios tied to office vacancies exceeding 30%. REITs with core office exposure, including Vornado and SL Green, declined sharply. Underwriting standards tightened, prompting banks to reclassify non-performing assets. Analysts warn of contagion into commercial lending and insurance corridors. Global transportation and shipping indices declined as demand waned. The Baltic Dry Index dropped 7.1%, while container freight costs fell 12% week-on-week between Asia and Europe. Logistics firms Maersk and Hapag-Lloyd revised forecasts downward, prompting stock sell-offs. Supply chain visibility shrank, and corporate guidance reflected cautious 2026 outlooks. Industry participants expect trade volume normalization as economic growth slows. Investor sentiment has shifted toward preservation rather than expansion. Market psychology is marked by heightened anxiety, diminished risk appetite, and a narrowing breadth of price action. Traders increasingly favor hedged strategies and diversified exposures. While short-term volatility remains elevated, structural adoption trends remain intact across institutional frameworks. Now, positioning with discipline and clarity is more important than chasing upside. If this fast-moving global overview sharpened your market instincts, hit like, subscribe, and press the bell to stay updated in real time. Let us know your biggest concern today, whether that's macro risk, deflation, or crypto flows.